Click the bell icon to get latest videos from Ekeeda.
Hello friends. Sometime at university level, we come across question where we don't have complete balance sheet and income statement. They may provide certain information as additional information below the balance sheet relating to the income statement. In such case, we are required to properly read adjustment and find out the missing information to calculate required ratios. How to do that? We'll understand in this question. Let us read this question. Following is the balance sheet of Bliss and Happiness Limited as at 31st March 2013. Balance sheet as on 31st March 2013. Asset side we have machinery, fixed assets. Investment, these are long-term investments. Stock in trade, current asset. Bills receivable, current asset. Trade receivables, current asset. Cash and bank balance, current asset. Profit and loss account, this is debit balance, this is a loss, this is a fictitious asset. Liability side, equity share capital, general reserve, reserves and surplus, 10% preference share capital, 15% debentures, borrowed funds, trade payable, current liability, bank overdraft, current liability, provision for taxation, current liability. So here we got information of assets and liabilities because balance sheet is given in the question. Below balance sheet we have certain information. Sales for the year rupees 7 lakhs. Gross profit rate 25%. Opening stock is rupees 1,09,000. Profit before tax for the year ended 31st March 2013 is 2,10,000. You are required to compute the following ratios and comment on current ratio. Here specifically they have asked to comment only on current ratio. Current ratio, acid test ratio, stock turnover ratio, capital gearing ratio, proprietary ratio, debt equity ratio. They have given how to calculate it, debt divided by net worth. Return on capital employed. Further they say that redrafting the given balance sheet in vertical format is not expected. So as it is clearly given in the question that vertical balance sheet need not be prepared, we are not required to draft the same balance sheet in vertical format. Let us continue and we'll calculate the various ratios. First we have current ratio. Formula for current ratio is current asset divided by current liabilities. Here we have current assets, stock, bills receivable, trade receivable and cash and bank balance. Current liabilities we have trade payable, bank overdraft, provision for tax. Total current assets 2,08,000. Total current liabilities 1,60,000. Current asset divided by current liabilities, it is 1.3 is to 1. In question they have clearly asked comment on current ratio, means we are required to also provide comments on current ratio. Current ratio of company is 1.3 is to 1. Standard current ratio is 2 is to 1. It means ratio 1.3 is to 1 is not satisfactory. It indicates that company is having problem relating to short-term solvency. During short term, their current assets are not sufficient to pay off their current liabilities. Standard current ratio is 2 is to 1. Company's current ratio is not satisfactory, indicating unfavorable short-term solvency position. Company should increase current asset and decrease current liabilities or both to achieve standard ratio. Next we have acid test ratio. Acid test ratio means quick ratio. This ratio shows short-term liquidity position of company. Formula is quick assets upon quick liabilities. We have already calculated current asset and current liabilities. So based on that, we can calculate quick asset and quick liabilities. Quick assets is equal to current assets minus stock minus prepaid expenses divided by current liabilities minus overdraft minus income received in advance. Total current assets 2,08,000. Total current liabilities 1,60,000. Here stock in trade 1,01,000 is given. On liability side we have information of bank overdraft 20,000. Quick assets 1,07,000. Quick liabilities 1,40,000. So we get answer 0.76 is to 1. Here company is having quick liabilities 1,40,000 and quick assets only 1,07,000. So even liquidity ratio, asset test ratio of company is unfavorable. It should be at least 1 is to 1. Next we have stock turnover ratio. Stock turnover ratio formula is cost of goods sold divided by average stock. we are required to calculate these two values first. Sales for the year is given 7 lakhs and gross profit rate is given 25%. So we can calculate gross profit. So gross profit we got 1,75,000. Now we can calculate cost of goods sold, that is sales minus gross profit. Sales we have 7 lakhs minus 1,75,000. So we have cost of goods sold 5,25,000. Average stock is equal to opening stock plus closing stock divided by 2. Opening stock is given here 1,09,000. Closing stock we can get from balance sheet. This is a closing stock 1,01,000. So we have opening stock 1,09,000, closing stock 1,01,000. 1,09,000 plus 1,01,000 divided by 2. So average stock we have 1,05,000. Cost of goods sold we have 5,25,000. Now we can calculate stock turnover ratio. Cost of goods sold divided by average stock. Cost of goods sold 5,25,000. Cost of goods sold 5,25,000. Average stock 1,05,000. So stock turnover ratio is 5 times. Next we have capital gearing ratio. Capital gearing ratio, capital with fixed income divided by capital with flexible income. Capital with fixed income we have 10% preference share capital 1,80,000, 15% debentures 1,20,000. Capital with flexible income means equity shareholders fund, equity share capital plus general reserve minus fictitious asset, that is profit and loss account. Ten percent preference share capital 1,80,000, 15% debenture 1,20,000 divided by equity share capital 1 lakh plus reserves 70,000 minus fictitious asset, profit and loss account debit balance minus 14,000. Three lakh divided by 1 lakh 56,000. So it is 1.92 is to 1. It shows that companies having fixed income capital 3 lakhs, that is higher than flexible income capital 1,56,000. So it can be said that companies high geared and taking benefit of the borrowed funds and fixed income securities. Next we have proprietary ratio. Proprietary ratio formula is proprietor's fund divided by total assets multiplied by 100. For calculating proprietor's fund, we are required to add equity share capital, general reserve, preference share capital, and we are required to deduct profit and loss account, that is fictitious asset. Proprietors fund we got 3,36,000 and total assets 6,16,000. So it is 55.45%. Standard proprietary ratio is 65%. So long-term solvency position of this company is not satisfactory because proprietary ratio is less than standard. Next ratio we have debt equity ratio, that is debt divided by net worth. Here debt means borrowed fund, long term borrowed funds. Here we have 15% debentures. Debt equity ratio, debt divided by net worth. Debt 15% debenture, net worth equal to proprietor's fund. Proprietor's fund already we have calculated 3,36,000. 15% debentures is 1,20,000. So debt equity ratio comes to 0.36 is to 1. Here company is having less debts and more proprietors fund. This is good for long term solvency of company. Next ratio we have return on capital employed. return on capital employed, net profit before interest and tax divided by capital employed multiplied by 100. Let us calculate first capital employed. If we adopt asset side approach, we can get capital employed with this formula: total assets minus fictitious assets. Total assets here 6,30,000 and profit and loss account 14,000 is fictitious asset. So 6,16,000 is amount of capital employed. Profit before tax is given 2,10,000. Net profit before tax and interest. We have information of net profit before tax, that is rupees 2,10,000. For calculation of interest, we are required to see 15% debenture. Amount is 1,20,000. So on this 1,20,000, we are required to calculate 15% interest. So it is 18,000. So net profit before interest and tax, total amount will be 2,28,000. Now we got net profit before interest and tax 2,28,000, and also we have figure of capital employed. Now we can calculate return on capital employed. Two lakh 28,000 net profit before interest and tax divided by capital employed 6,16,000 multiplied by 100. So it is 37.01%. Thus we have also calculated return on capital employed. In this question we have learned that some information may be given in the question in direct form, like balance sheet is given, so it becomes easy to calculate ratios. But when along with the balance sheet they give some information relating to income statement, we are required to find out the missing information by reading the adjustments very carefully. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.